Richard Harris, Executive Director at Port Shelter Investment Management, is now on the show. Richard, thank you very much for joining in. So let's begin by finding out what smart money is doing when it comes to emerging markets and trade and investment.
Well, I don't know. Smart money is always the smart money. Maybe it's actually just dumb money. But, clearly there is a lot of enthusiasm in the markets at the moment. We have seen a fall. I think markets will be encouraged by the fact that although there was quite a serious fall last week, they've moved up again. But we are getting into the era where I think markets are quite fragile. The fact that they're positive in Western markets means that they'll also be positive in emerging markets. And of course, EM and small caps are doing quite well. But I think investors should be quite cautious about the real motives behind the market moves. And I would be careful at the moment about how I was investing new money.
Why should investors be cautious? You're calling the markets fragile.
They are. Well, they've gone up a lot, of course. That's the key thing. We have a US market that's holding its own, but the bias is not on it getting stronger, perhaps more weaker. Falling interest rates in the US might help to extend this bull market, but markets don't really go up like this at this sort of pace forever. Sooner or later, they have to have a breather. And a breather like last week just didn't touch the sides.
Smart money, dumb money, smart money. That's a nice way to characterize that. But yeah, I mean, the roles change, right, depending on what you're doing and whether you're winning or losing in that sense. But so what do markets do? You think this is not done yet? That's the feeling I get from what you said on the downside.
Oh, that's right. That's right. Markets at this stage are very much behavioral. They're very much dependent on narrative. And I think while there's a positive move in the market, while there's still real cash that's being raised, and we're talking about huge amounts of cash. I mean, Amazon is coming out with an enormous bond that has a 100-year maturity. People are looking at new ways to do the funding. While there's cash around, markets will go up because that cash has to be deployed somewhere, temporarily or longer term, or people thinking the AI boom is going to continue. But we've seen this before with the dot-com boom. Yes, it resulted in a lot of value being added to economies that was not there before. But don't forget that Amazon, which reached an all-time high in around 1999, didn't touch that high again for another 10 years or so. So I think we just need to be a little bit cautious. Yes, if you're in the market, it's great to keep running it. But sooner or later, I think the music's going to stop.
Hi, Richard. Good morning. Good to see you. Ben, what about the music just started playing for the Indian markets? We were underperforming last year. It seems the dance floor was on fire, but we weren't dancing. But now it seems we have got our act together, the breakdance on. Do you think that the Indian markets outperform from here on?
Well, yes, Nigel, congratulations on 15 years, first of all.
Thank you so much, Richard.
You don't even look 15, so I'm very impressed.
You make me feel good.
Clearly, you've aged a bit while you're on the job. Yes, on the Indian markets, I mean, of course, we had a weak period over the last year to 18 months, but don't forget how well it had done beforehand. One of the better performing markets in the world. Year after year for quite an extended period. So let's face it, it was time to have a bit of a breather. There was more attention, more focus on China, which I think took away the attention of foreign markets. But yes, I think that the moves, first of all, for increased trade in Europe, increased trade with the UK, and then we had the Trump deal last week, which, of course, with Donald Trump is always a bit uncertain, but, it's good news. I think all of these are very positive for the Indian market looking forward.
So, Richard, since the view is cautious from here on, how do you position your portfolio right now? Are you exiting, scaling back some of your investments in emerging markets? Tell us a little bit more about constructing the portfolio at this juncture.
Yes, not really emerging markets. I've had quite a lot in the US and run the, of course, the Mag 7 up. But, I think that good investors do things when they don't really want to do it, to be contrarian. So I'm not saying I'm a good investor, but I did think it was right when some of these stocks sort of run up a long way it was right to take cash. Now, deploying cash into emerging markets, I think, is a good thing, and I was doing that last year. But also deploying cash into certain sectors, the defense sector is clearly something that's getting a lot more attention. But I think that if you're looking at a strategy in this environment where markets do look fragile, then you need to look at something like a barbell strategy. So a lot of the cash that I raised from positions that were really just too high and seemed risky if you looked at them, if you like, from a white page point of view, just left it in cash. And a variety of cash, both euros, Swiss francs, and US dollars, because I think that having a barbell with a chunk of cash, which is in fact your security, because you don't know if a piece of news may come out and cause the markets to fall, plus retaining your holding in equities because they're still moving on. I think that's the best you can really do at the moment. It's not exactly hedging your bets, but it is reducing your risk to the complete blowout in markets that we're having at the moment.
All right, Richard, we'll leave it there. Thank you very much. You don't look very old yourself, Richard.
No, you're too kind.
I think I could put maybe a 40, 45.
Yeah, I'll pay you later. It's moisturizer that's the key.
Thank you very much for that. Good conversation.